Hi, thanks so much for joining in. This is Your Money Matters on NDTV Profit, and my name is Alex Matthew. I have a confession to make. In the first 3 or 4 years of my career, I did not make any investments, and quite a lot of my money, whatever was there, because I was not earning very much, most of it was lying in my savings bank account. And I think if I look back, this is the one thing that I wish that I could change. And the reason is that is the most unproductive usage of money. Well, not the most. The most unproductive would probably be if I withdrew all of that money and kept it under my mattress. We'll talk about what you should do in the current context, especially because a lot of big banks are cutting the rate that they're offering on savings bank accounts. They had already cut it, they're cutting it further. So we will pull up a table for you if we can. State Bank of India was offering 2.7% on its savings bank accounts. That continues to be the case. But HDFC Bank, ICICI Bank, Axis Bank have all cut their rates to 2.75%. Even the smaller banks, which offer a slightly better rate, even they've cut. So IndusInd Bank, for example, has cut to 3.5 to 5% from an earlier rate that they were offering of 4 to 6%. RBL Bank is also cutting to 4.5 to 5.5%. They were earlier at 5.5%. And PNB is at 2.7%, Bank of India is 2.75%. So they've, by and large, across the board, you're seeing a drop. It's criminal, particularly if you talk about the post-tax amount that you're getting. It's criminal to keep money lying here. We'll talk about why and what your alternatives should be. And we'll also talk about a category of mutual funds on this program, multi-asset funds. At a time when gold prices are hitting at all-time highs, you will see a few of these schemes that are outperforming. Should you be investing in them? What should you do? Joining me to talk about all of this and more, I've got Mohit Gang, co-founder and chief executive officer of Moneyfront. Mohit, thanks so much for joining in. I was comfortable making that confession because I know that a lot of my viewers will be or have been in the same boat. But it's criminal to do that right now. Wouldn't you agree?
Oh, absolutely, Alex. And you can't be further away from truth when you say that it's absolutely criminal. It's absolutely criminal to park your money in savings account and forget about it. Whatever little balance you have, even if it's a drop in the ocean, the drop shouldn't be wasted. I think the golden and the most fundamental rule of money is the more you respect it, the more the money will respect you back, right? So you need to really put it to work. And by putting it to work, I mean you have to invest it prudently, you have to park it prudently. So whatever little balance, and I think that's where retail investors typically go wrong. They think that keeping that 50,000, 1 lakh, 2 lakh, whatever amount aside in savings account is like whenever they might just need it, they can withdraw it. But rather than doing that, they should ideally be parking that fund in a liquid fund or an arbitrage fund, which is absolutely withdrawable at their beck and call. Right. So anytime you have clarity of over 7 days, Alex, I would urge everyone to look at categories like liquid. If you have clarity over 1 month, 3 months, then look at categories like arbitrage. And if you just don't have any clarity, then look at categories like overnight fund. Even if it is for 3 days, you should be parking your funds out there. These are categories which are absolutely safe. This will give you, currently the rate of return is somewhere in the range of around 7% odd, give or take 50 bips. That's the kind of fluctuation you can see for some time forward, right? And even on a post-tax basis, the return as compared to a savings account balance, which is at 3% currently, is massively different.
Yeah, actually 2.75%. So if we're talking about this, Mohit, just to drive home the point, for those that understand inflation and the impact of inflation, of course, this is really basic stuff. But let's break it down because it's important to understand. I always use the example of taking a 500 rupee note and putting it in the cupboard and going back in a year and saying, how much can you buy with that 500 rupees? It's less than what you could buy 1 year back. And it's a similar policy that's playing out in the savings bank account, except there's also a tax that you're paying. So it's even worse. You're effectively paying the bank, aren't you?
Absolutely, absolutely, you are. And just to take that analogy forward, Alex, let's say if our parents would have forgotten a lakh of rupees in 1984 and just kept it idle in the cupboard, that lakh of rupees then is worth only 7,000 rupees now. So that's the power of inflation, which kind of erodes your money so dramatically. Right. So just for a layman perspective, getting, let's say, 2.7 to 3%, and for simplicity of computation, I take 3% as savings interest rate. It's also fully taxable. So whatever interest you are earning is fully taxable at your marginal rate. Assume you are at the highest tax slab, and so post tax you're making 2% out there. The similar tax rate applies to a debt fund also, which is a liquid or an overnight fund. Out there, if you are making 7% pre-tax, post-tax will still be 5.5. That's a dramatic difference. But the more important part is you are taking care of inflation at least. Inflation today is around 4.5, 5% You're making 5.5 post-tax out there. So at least you are not losing the real value of your money. And if you are a little adventurous, if you have some time, which is a month and over, and if you can do that parking in arbitrage fund, the taxation is even more effective, Alex. Out there, you only pay equity taxation, and the post-tax returns are really handsome. So on a 7% pre-tax return, even if you were to pay a short-term equity gains tax of 20% on that, you lose only 1.5. You take home around 6.6, 6.5%, which is fantastic.
Yeah, indeed. And that's part of what I want to talk to you about. Let's talk about arbitrage funds, because ever since that change in the tax treatment of debt funds, which is ultimately that all your gains, irrespective of interest or capital gains, are treated as short-term capital gains and they are taxed at the slab rate. Ever since that happened, Mohit, a lot of people started investing more into hybrid funds. And among them, for their short-term requirements, they have deployed into arbitrage funds. So first, before I get to that, since we've been speaking about limiting the amount that you keep in savings bank accounts, which banks are not going to be very happy to hear, but nonetheless, how much should you ideally keep in your savings bank account? Should you treat it like a wallet more than anything else?
Alex, look, my sense is you should just keep zero out there. You should park everything in a sweepable FD. If you really need liquidity, a sweepable FD gives you the same benefit. You can withdraw cash through a debit card, right? So you park that 20,000, 25,000, or whatever could be your daily or an emergency requirement of withdrawable corpus. You park that in a sweepable FD, and anything over and above that should go into an overnight liquid or arbitrage, depending on the time horizon which you have available.
All right. So let's talk about the options available in the mutual fund space, right? So before we get into liquid funds, let's talk about arbitrage funds, because as you pointed out, there's a clear tax advantage. How do they work for those that don't understand?
Okay, so look, arbitrage is not a very easy concept to understand for any retail investor. Basically, it operates in two markets, which is operating in a cash market and operating in a futures market. So typically, the fund manager out there is buying in cash or selling in future, or buying in futures and selling in cash, and making good of the arbitrage opportunity which exists. Now, typically, this arbitrage opportunity is supposed to fetch him more than the daily call rates in the market, or more than the interest rate, which is a short-term interest rate in the market. So let's say 100 rupees of his corpus in arbitrage. If he finds those kinds of arbitrage opportunities, if he finds that there is an arbitrage opportunity which is fetching him more than 6.5, 7% then he will make good of that arbitrage opportunity. If he doesn't find, then some portion of his corpus will go into short-term debt instruments, which you typically find in a liquid fund, right? So in a normal arbitrage fund, you will find 60% being deployed in arbitrage opportunities, around 30% being deployed in debt, low, what you would call as low maturity debt, or a short end of the debt curve, and 5-10% in cash. That's how a typical arbitrage fund is composed of. The better the arbitrage component, the better the returns. That shows that the fund manager is finding good opportunities or good differences between the cash and the futures market. And a good smart fund manager will always be able to identify that. So in an arbitrage fund, you typically have to figure out a good fund manager, a good track record of the fund, and a fund which is having higher arbitrage component as compared to debt component in the portfolio. They are absolutely safe because there are no naked equity positions per se, which means that they don't take any long equity position or any open equity position. Everything is hedged. So there is no chance of capital getting eroded. However, these can be hugely volatile. So an investor has to understand that.
Ask that because since it's equity and since there's derivatives involved, ultimately people will worry. People who don't understand how this works necessarily, or people who are not very familiar with the derivative space, which is, I think, a large number of people. Is there a loss of capital? And you've actually explained that there is no potential for loss of capital. Can there be volatility in the kind of returns that you generate, though? That's the question. Because in a liquid fund, you know that they're very short-term debt instruments, practically overnight debt instruments that are invested in, and you get a certain amount of coupon. It's very clear. Or you get not coupon, but you get a very clear amount of yield or spread on that. So therefore, what do you need to bear in mind on arbitrage funds? Is there a variability of the return that you get?
There is, Alex, and one has to be very, very clear about it. Look, there have been instances in history for 1, 2, 3 months, in fact, where arbitrage funds have gone negative, right? So those instances have been there. Those were black swan events which can happen anytime. So I'm not ruling out the possibility completely out of the window that arbitrage funds cannot go negative. They can, but those are, again, as I said, very, very rare instances, and history doesn't have too many of them, maybe 1 or 2 cases where arbitrage has actually gone negative for 1 or 2 months. That's about it. But the volatility can be huge. Volatility can be huge given a scenario where markets are consistently falling, given a scenario where interest rates are hugely volatile, given a scenario where the arbitrages typically go away from the market, or given a scenario where the future outlook is extremely bearish. So there could be some scenarios where arbitrage funds can be very volatile. The return range can swing heavily from 1 or 2%. But even then, Alex, if you have patience of 3 months, my sense is 3 to 6 months. My sense is arbitrage funds typically stabilize and give you a pretty steady state of returns within a 3 to 6 month. And if you have a horizon of around a year, then nothing like it. Okay. Right. So within that time frame, they will stabilize. The return won't be linear, but return won't be hugely disruptive also. So you can pretty well expect a range of, let's say, the outer range can be 5.5 to 7.5 currently.
Talk to me about the category average as a whole. You've listed this out. You've said 3-month return is about 7.38%, 6-month is 7.15%. And I'm assuming that this is the category average. What is the kind of variance in that in terms of the better performers versus the worst performers?
Around 25 to 50 bips, Alex. That's the typical range. So if the category average is 7, I think the better performers would be somewhere around in the range of 725, and the worst ones would be in the range of 675. So the variance isn't like too huge. It is never like an equity variance where one can go 2, 4, 5% over and above the mean returns. Out here, that's not the case. And so is the case with any other debt instrument, which is like liquid and overnight also. So the variance is typically low, and even the volatility is low.
Okay. Now, so the option, of course, here is liquid funds, and there are still takers for liquid funds. Just by dint of people having done it for so long, it's used as an instrument where you park a certain amount of money, of course, and it's used strategically as well, Mohit, because even a Parag Parikh, for example, that only had for the longest time one equity fund, which was the FlexiCap fund. They had a liquid fund because they said that they needed to provide an option for someone who would do a systematic transfer plan or basically a consistent shift from one scheme to the other when you have a lump sum that you don't want to put at one given time. So should you use a liquid fund in the current context? What should you bear in mind?
Oh, absolutely. Look, honestly, liquid and ultra short debt has been fetching much more than arbitrage for past 3, 6 odd months, because the liquidity was extremely tight, and suddenly RBI came out with a lot of OMO auctions and other things, and the liquidity eased off. And the moment the liquidity eased off, the short-term yields came off, and that's where there were huge returns to be made in liquid funds and everything. But leave that aside. My sense is liquid is a great instrument. It's much more linear than arbitrage or any other category of debt. Honestly, there isn't too high variability in that. There isn't too much of risk involved in that. It's a very low risk kind of a product. It's a steady state of returns which you can keep generating out there. On a post-tax basis, it is much higher than your savings account. It is comparable to I would say a 6-month FD return right now, or even a 1-year FD in some cases. So that gives you enough and more flexibility, because liquid returns you will make for 7 days, 10 days, 30 days, whatever tenor you want to park, and you can break that in pieces and chunks. You need
Yeah.
not withdraw the full corpus like how you break an FD, you break the complete FD. So that's not the case with liquid, right? So investors typically don't understand these finer nuances, and the money is available in your bank account the very next day. So these are great benefits of liquid. The return is absolutely fantastic, absolutely linear returns, very little volatility, variability, no risk per se on capital,
Yeah.
extremely safe instrument. So yeah.
Okay, but do bear in mind, of course, this goes without saying, but I'm still saying it, Mohit, that in a falling interest rate scenario, depending on how far the interest rates go down, you will to that extent get lower returns in your liquid fund. But of course, that is the case across the board. That's why we started the conversation with mentioning the fact that savings account rates have fallen by 25 basis points. That is in line with the fall in the interest rates at the policy level. Let's talk about another category. And here, this is also the hybrid category, but it's, of course, a much longer term instrument that you invest in, which is multi-asset. And it's been finding a lot of takers, Mohit. And the reason I want to talk about it today is that we have gold prices that are, even as I speak with you, at all-time highs. And there are a few schemes that have taken oversized exposure to gold. I'm assuming that these are the schemes that have outperformed over the last 1 year. Have you indeed seen that?
Oh, absolutely. I think anyone and everyone who had gold in the portfolio by direct allocation, by virtue of having a multi-asset fund, they have done fantastically well. They have resisted all kinds of market fall. And I think kudos to the industry for coming out with this kind of a combination, which is an automated diversification for investors who really don't have a ball on their asset allocation. So for someone who doesn't want to take active calls between equity, debt, commodity allocation, I think multi-asset serves the purpose. It's a great auto asset allocator kind of a tool. And out there, if you see, there is huge variance amongst funds on what is the equity composition, what is the debt composition, and what is the commodity composition. Even within commodity, you find funds varying a lot between gold and silver. And that's typically given a huge divergence of returns amongst the entire set of funds which we have in the industry.
Okay, let's talk about some of these, right? Because White Oak stands out as a mutual fund scheme, or I'm talking about the multi-asset allocation fund, which has a sizable allocation to gold. Even as last data that you've shared with me, it's about 15.3% allocation to gold, 39 odd percent to debt, 29.4 to equity, none to silver. But this is the reason why it leads the chart with a one-year return of 14.16%, significantly higher than the sector average. Is that likely to continue? And what are the other schemes? You mentioned a few more. Mirai Asset, for example, you have DSP, you have Quantum, ICICI Pru. ICICI Pru does not have a very large allocation to gold, but it does have allocation to silver. And I guess that's also been a kicker.
Absolutely. Absolutely. So look, Alex, as I said, there is no two doubts that schemes with higher gold composition have done well. But it is a combination of two assets working for you in most of these multi-asset schemes, if you notice very closely. So for White Oak, let's take that example. 15% gold has done phenomenally well, but so has their debt exposure of almost 40 odd percent. They are low on equity. If you see across the multi-asset funds, they are, I think, amongst the lowest on equity composition, which is just 29, and which is the asset class which has actually not performed in last 1 year, right? So that's where the most amount of hit has got come in. But now that the equity is rallying back from last 1 week or 10 days or a month or so, I think the composition of funds which will now lead the charts will change dramatically. Having said which, if the fund manager is active enough and have prudently or timely changed allocation, then that's a different case. We only come to know of that in a hindsight of a month when the portfolios are disclosed. But yes, last 1 year, if you see White Oak with the highest gold allocation and the lowest equity allocation has done phenomenally well. So has DSP with a very high gold allocation and a very different overall equity mix in the portfolio. Yeah. And Quant also, if you see the equity allocation is pretty low, but the debt allocation is very high and the gold allocation is steady out there. So these are few schemes which have actually done well, A, because of commodity exposure, and B, because of a higher debt allocation also.
Okay, sorry, were you talking about Quantum?
Quantum, sorry, my bad. Quantum.
Quantum. Sorry. Okay, so, there's also, incidentally, I spoke about gold yesterday with a commodity analyst, and his advice is perhaps it's time to take money off the table. The kind of run that you've seen in gold is just phenomenal, and I guess it's a symptom of what we're seeing around the world. There's increased uncertainty. But if you have invested in something like a multi-asset, that doesn't mean that you book profits, but you could see a relative underperformance. Is that a possibility if gold cools off very suddenly?
Okay, so
In the
there are
schemes,
various
I'm talking about in the schemes that, okay, so what is your opinion on gold? Let me break this down. What is your opinion on gold? And because we've discussed schemes that have higher allocation to gold, if that reverses, could we see a period of underperformance?
Okay, the first part, Alex. Look, I will have to say it with a pinch of salt that the run up in gold has been too soon, too fast, too ferocious to be true. Honestly, any asset class, not just gold, but anything which gives or delivers this kind of a return, you have to take it with a pinch of salt. My only advice out here will be, don't get under any FOMO. For any investor, that if they haven't invested in gold so far, please don't jump in at these levels. It's absolutely not a level to increase your allocation in gold or to start afresh right now. These are crazy, insane levels on gold which we are seeing, right? Taking profit off the table out here, yes, if by virtue of asset allocation the composition of gold has actually shot up a lot in your overall portfolio, then you need to rebalance and get it down and trim it down, and this perhaps is the right time to trim it down, right? So not a time to get in. And if you're overweight gold right now, yes, it's the right time to trim down your allocation. That's my call. But if you're underweight, then perhaps just hold on to that allocation, right?
Okay, fair point. And you already mentioned that some of these schemes, if they're active enough, they could, work
Yes.
their allocation and ensure that underperformance is avoided. But come to the final point and what your recommendations in this space would be, because when you're investing in a multi-asset fund, first of all, what is the time horizon that you need? What is the allocation in your portfolio? Because it's not going to do away with your requirement for asset allocation. And what is your objective? It's not return generation, really. It's a combination of multiple factors. You want some capital generation, but you want capital protection as well. So what should your expectation be?
So look, basically the underlying promise or thesis of a multi-asset fund is that there is an automated diversification which an investor need not bother about. If there is an extraordinary volatile movement in any one asset class, the other two asset classes come in handy and kind of preserve the portfolio or hedge it out. So these are some underlying promises, right? And out here we also go with an assumption that the fund manager is active enough to move the allocations. So we typically don't track a good multi-asset fund by virtue of its returns or even by virtue of its composition. We track a good multi-asset fund by virtue of how sharp the movements have been between the asset classes, right? So if someone has been nimble enough to now perhaps trim down commodities and move more towards equity, trim down debt and move more towards equity, that's a good call, and that's a great multi-asset fund. But yes, for investors who are already invested, they need not worry, because the whole promise is that the fund manager is doing the right asset allocation. And if he thinks that gold has outrun its rally, then perhaps they will trim down the allocation and move more towards equity or debt as they deem appropriate in the portfolio. So multi-asset fund is a fund for ages. You can continue holding that fund because it is doing all that what an active investor needs to do by himself or herself. So the fund manager is doing that actively for you, and out here the whole premise is that he's taking the right asset allocation moves.
Okay, and you can have an oversized allocation from that perspective if you have a relatively low risk approach, or if you don't want to have an active hand in deciding how much allocation towards asset classes and how much allocation towards within equity as well, market capitalization wise, right? So which type of investor puts a large amount of money into multi-asset?
Typically, look, Alex, multi-asset and balance advantages are these two categories where we've often seen too much of very, very conservative investors, retired investors who are wanting to safeguard their portion of money and not wanting to take too many chances in the portfolio. I think those are few profiles which typically invest or park a lot of funds in multi-asset and more hybrid and balance advantage kind of categories. And by virtue the way the fund is constructed, this is pretty conservative approach, because the equity composition, and you can choose your equity composition, right? You can choose funds which are a little conservative on equity. Equity will be 25 to 50. That's the band typically. There are very few funds who go above 50 on equity, right? So you can typically figure out a fund which is a little low on equity and gives you a very good mix of fixed income and gold in the portfolio.
Okay.
And other than gold, you get silver, sometimes you get REITs, InvITs. There are multi-asset funds which have some international allocation also. So there is a good basket and a good mix which you get, and it's for more conservative,
Yeah.
retired kind of profiles. For someone who is very aggressive, young, wanting to take chances, I would not say multi-asset is a can be a great part of the portfolio.
So with that caveat, Mohit, what are your favorite funds in the category? Not a recommendation, but what do you look at closely?
Look, we typically like DSP multi-asset fund. We like Nippon multi-asset. We like Pru ICICI multi-asset. White Oak of late has been doing pretty well because of the commodity allocation, as I mentioned you. But yeah, those were the three choices which I mentioned. I think are the ones which like.
Okay. All right. On that note, Mohit, thanks so much for joining me. Always a pleasure having you on the program. We've discussed both your short-term as well as your long-term needs on this program so far. By the way, if you've got specific questions about how to manage your money or money hacks that you want to know about, write to us in the comment section and we'll take it up. Do stay tuned. This is NDTV Profit.